If you think raising rents is the fastest way to boost profits, think again. Because if your units are sitting empty, what you charge for rent doesn't matter. Welcome to Strategy Saturday. I'm Charles Carillo, and in this episode, we're breaking down how occupancy drives multifamily performance and why top investors obsess over it, especially during market pullbacks. So let's get started. When speaking to a lender about purchasing a specific apartment complex, one of the first questions they will ask is, what is the property's occupancy? And this is because occupancy is a fundamental driver of making money with multifamily properties, really rental properties of all types. And in previous episodes, I broke down vacancy and the cost of tenant turnover. And these episodes are SS237 and SS240. So I don't want to go into these too much, but rather focus on why occupancy is an essential metric to track, since it will be one of the first things that lenders, brokers, and buyers ask you. When I refer to high occupancy, I mean a property that is 90% or more occupied, as this is typically what lenders consider a stabilized property. As a side note, there are two types of occupancy. There's physical occupancy, which is the actual number of units occupied, and economic occupancy, which is the percentage of potential rental income that is actually collected, as opposed to the total potential rent if all the units were leased at market rates. Now, physical occupancy is what I'm referring to in this episode and is what most professionals typically refer to when discussing occupancy in general. Number one is that high occupancy immediately equates to a good, well-managed property. When I see a property with an occupancy rate under 85%, I immediately try to determine what is wrong with the property. A property is considered exceptionally well managed if its occupancy rate is 95% or higher. At 100%, your rents may be too low, and at 85%, it may seem that your rents are too high. Alternatively, there may be other issues lurking beneath the surface. That high 90% occupancy range is typically the sweet spot that investors strive for. Number two is occupancy has a direct impact on the property's revenue and profitability, and you cannot maximize a property's net operating income or value without achieving a high occupancy at the property. Additionally, every occupied unit increases the property's operational efficiency as fixed costs are now spread over more units. For example, it costs the same amount of money to light the parking lot or mow the grass regardless of whether the property is 70% or 90% occupied. Number three is an impact on financing. Financing can vary significantly depending on the property's occupancy rate. And since financing is really, that lender is really your largest partner in your deal, right? Sometimes bringing 70, 80% of the capital to buy the property, two properties next door to each other, and one with a 60% occupied and the other one that's 90% occupied, will usually not be financed by the same lender. I mean, the loan to value ratios will differ. The interest rates will vary, and the loan terms will also vary. Major lenders such as Fannie Mae and Freddie Mac consider all properties with occupancy rate below 90% as unstabilized. In short, high occupancy ensures the lender the property generates sufficient cash flow to cover the debt servicing, which is what the lender is really concerned about. And occupancy is the backbone of profitability when investing in multifamily properties, especially during down or stagnant parts of the market cycle. And during these times, keeping your units filled and not chasing rent increases is the smart strategy, while pushing rents and doing major renovations is best suited for markets on the upswing. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.